Yeah, sorry for the moving screen, but my cat is having a moment wanting attention, but at the same time, every time I pet him, he doesn't want to do anything. He doesn't want attention. So my name is Daniel Young. I am the owner and founder of Adaptive Perspective, and the Adaptive Perspective channel where I help you make your dreams a reality. If you've seen any of my previous videos, you know I love strategy. I love targeted strategy. And that awareness is key because I'm going to keep sifting these financial memes using our investment strategies along with some just everyday down to earth common sense. Reminders, this is an unedited video. Who knows what else you'll hear in the background as I film these in my house. And today I am showing our strategy of closed-end funds because it relates to what we're going to talk about. And I am not a financial advisor. I'm a financial strategist. I love financial strategy. I like strategy in general. Um, And to be quite honest, you need to know your strategy because everybody's got an opinion. And I completely realize that this is an opinion, but everybody's got an opinion. And you need to know your opinion and you need to know your strategy so that you can better sift other people's opinion. So I'm not out to slander anybody. I'm just interested in separating the good from the bad because none of us want bad advice, especially none of us want bad financial advice. So let's get into this. So this is my page on Pinterest. And if we go to this board, at the end of that board or towards the end of that board, you'll find this. And I completely stand by what I said. It's not my goal to slander anybody. But I'm also going to say that the Motley Fool, from my perspective, is called fool for a reason because they don't give the best advice and they make you pay for the advice they give. So this thing right here, so 5 stocks under $49. To get access, you would click, this is an image, it's not a link, but to get access to this, you would click their link and sign up, and they would send you a ton of trash emails. And then you would sign up for the service. And it's not $49. So I have a problem with this. I mean, I have a personal problem with this, one, but from a business standpoint, from a financial standpoint, this isn't the best advice. Now, it sounds amazing to people who are in the general market, because if you look at Coca-Cola, that's more than $49. If you look at Microsoft and Google and Amazon, that's more than $49. If you're aware of Berkshire Hathaway's prime grade A stock, you're paying $40,000 a share. So 5 stocks under $49 for the average investor, for the green investor getting into the market sounds pretty good because that's a lot cheaper than most everything else in the single stock version of the market. But for whatever reason, the closed-end fund section of the market continues to stay under radar. Now, listen to this Warren Buffett quote. When it comes to the stock market, you want to find a stock that you can get for 67 cents instead of a dollar. So if we put that in coupon terms, if you're buying something at the grocery store that's a dollar and you're going to buy it for 67 cents instead, that would be, you're going to try to find that for 33% off. You can't do that in the traditional stock market, but that's Warren Buffett. He invests in the stock market. But there's a section of the stock market where you can find discounted funds, and they are significantly discounted. Now, they might be 1% off, or currently there's a fund that's almost 50% off. So in the closed-end fund area, this data is from, this data is from Saturday. It's the post-market data from end of trading on Friday. Now, this spreadsheet is my spreadsheet. It's membership view listed because at some point, yes, I do hope to make this a membership cost. But at the same time, by membership, I mean every single thing at the bottom would be included in the membership. So this spreadsheet is a list of all current closed-end funds. Everything in gray does not meet our parameters. Everything in white, I mean, it's on the page, but we're not really tracking. Everything in purple, somebody has recommended. Everything in blue, we own. And everything in green, we track for any number of reasons. So it looks like a ton of info, and it is a ton of info. I update the purple, the blue, and the green weekly, generally Saturday, Sunday. Uh, and then I update the entire spreadsheet every month. And if we look at this, I mean, this is an alpha order. Okay. If we do it by price, we'll do it in scale order so we don't scale to the bottom. Everything on here is currently less than $49. So they're going to tell you to pay their fee so they can tell you 5 stocks that are currently less than $49. And I'm telling you, there's 423 on this spreadsheet alone. Now, should you invest in all 423? No. No, we've sorted this list. So this is our standard. So, and I'll get to this. This triple asterisk system is a buy alert, meaning that current existing discount is double the individual fund. So all of these marked funds have been sorted based upon the fund's data and not the raw data of the entire spreadsheet. And this will make a little bit better sense in a second. So the triple asterisk has a buy alert because the current discount is greater, or really it's double the historical discount, and it's greater than the 5-year discount. If a fund is 3 years old, it's 4 years old, 2 years old. The current discount is greater than the discount that's experienced so far across the fund's existence. 2 asterisks would be a dollar cost average alert. So the blue funds that we own that are currently selling for less than our average of how we've bought them have a dollar cost average alert. And I'll be honest, transparent, authentic, however you want to say it. This is our self-managed portfolio on Webull. These are all the funds we own. You can pause the video. You can see our strategy implemented over time. So our existing strategy, was it our strategy when we started? No. Our strategy when we started was to buy funds on discount. And we've never paid a premium for any of these funds. Now we've come close to break even, but we've never paid premium or more than they're worth. All of these funds have been bought in discount territory. Say when we started, it was think back, it hasn't been that long since we've started this list, like almost 3 years. And it was buy at a discount. The strategy's changed over time. I mean, the current existing strategy is what I'm going to go back to. And that we want to target monthly. We'll buy quarterly stuff if we need to, like if it's just the time to do it. But the focus is monthly dividends, consistent monthly dividends, and dividends that are greater than 9%, which sounds crazy, but it's real in this market. So getting back, so 3 asterisks is a buy alert, 2 asterisks would be a dollar cost average alert. And then 1 is we're tracking for any number of reasons. So let's look at this. So if we scale by discount, this is based on Saturday's data with the market tumbling 700 points because inflation number, this is where what I call the circle junkies, the talk show guys, the financial guys that hit all of these different talk shows, and they all say the same things. It's a wonder none of them saw this coming. If you looked at your grocery bill, uh, amongst the Fed saying that inflation's better and all of these numbers are better, if you looked at your grocery bill and the cost of your utilities and the cost of your insurance, you would find out that that Fed number of hope for inflation was bupkis. Uh, so the market taking a tumble off January's inflation numbers being higher than expected was not a surprise. I mean, inflation will truly be tampered down when our grocery bills are cheaper and when utilities are cheaper. Little cat in the background. Uh, and I mean, I would love for that to be sooner than later, but it's probably not going to be sooner than later. And even when the Fed says, hey, we've reduced rates to 2%, I'm still not going to trust their data because they created this problem and lied about how they created the problem. They printed $4 trillion in a short amount of time and had the gall to tell us all, oh, look, we didn't realize how supply and demand worked. We didn't realize that if we printed $4 trillion in less than a year, that it would devalue our own currency. My then 10-year-old could understand supply and demand better than the Federal Reserve chair said he understood supply and demand on live TV. That's a crock of shit. So the Federal Reserve causes inflation, which means if you listen to the circle junkies that everything costs more, what it really means is that your dollar is worth less. It's worth less. And if you combine the two, it becomes worthless. It devalues currency. So the same people who created inflation are now tasked with fixing inflation. This doesn't work in any other job setting. And now we're going to trust their numbers that they fixed inflation? Seriously? But if you listen to the Motley Fool and the people that they talk to about the stock market, that's what they talk about. So the market at large is more like the Motley Fool than me and you. The market at large was like inflation's better. Bullshit. Like, at what planet are you on? So inflation is not better. What you and I knew. And you've got the Motley Fool parading their data around and making you buy stuff, making you buy their crappy advice when you can self-manage your own portfolio, which is what I want to teach you. So closed-end funds you can buy on discount. The net asset value is the value of the company. And you can buy their shares cheaper than what they're worth. And you can set your own strategy. You can set your own parameters. This fund is, I'll be honest, this fund tempts me to break my 9% rule because it is so cheap and it is so heavily discounted. They switched their portfolio. They were into bonds. They switched into real estate. In between the Fed switching rates around, we're all hoping that the Fed drops rates, but it's going to be hard with inflation the way it is. The Fed says it's this way. I would say it's higher. So if the Fed ever drops rates, this portfolio will be in amazing position because they're already switched from bonds into real estate. But in the meantime, they didn't have the overall profit to cover their dividends, so they cut their dividend in half. What their dividend used to be, okay, but then they transitioned their portfolio. Now it's this. Now, when the hope is that when that real estate market kicks off, they raise the dividend. So if you buy it now, I want to say our average price, yeah, it's close to $9, right? So if it goes up, it's a bunch of what if, right? But if the market turns and the Fed cuts rates, they will increase their dividend and that share price will jump. But why is this stuff in gray? It's annual. And this is in white. I used to track it. It used to be this fund. Somebody bought it out and changed the name. the discount never really closes. It's really just been the same amount, same spread. Annual. We own that. It pays monthly. This pays monthly. I don't like it, and I'll be straightforward and honest. Okay, I'll be authentic. It looks tempting, but they're invested in the social impact of the energy industry. So they're invested in everything that depends on oil, but they hate oil. So without oil, solar doesn't exist. Without oil, the industrial sector fails. And without oil, the energy sector and utility sector fail. I like solar if you're in a rural area. If you're in urban, I mean, you're just kind of supplementing your local power plant with no benefit unless your house is set up for it. But if you drive past somebody's house and see all those solar panels, unless their house is set up for solar, like they've got that solar panel is routed into a power bank that is then supplying the house individually with electricity and supplementing what they're getting from the power plant. What that house is doing is acting as a satellite power station for their local power station. It's not necessarily helping your electric bills. It looks neat, but it's not really doing anything. But if you live in the country or kind of in the edge between rural and urban, you can build your house to live off of solar, and you can significantly offset what you're getting from the power company. Where that gets into issue is how many power banks do you have? How many batteries do you have on hand? And can you survive through a hurricane on solar? And it depends on how cloudy it is. So I think it's an interesting concept, but it's not, it's like they hate oil, but at the same time, you have to have oil in order to make all their stuff work. It doesn't work. Um, all this stuff in gray is either like Cuba, we owned at one point. I don't like their current portfolio and structure. A lot of this is either out of our price range, pays a dividend under 6%, or it's not monthly. Um, not everything we track is monthly, but a lot of it is monthly. Um, so if we take the overall discount and then we break it into targets, you end up with a hefty amount of targets. And what I do every week is I take these triple asterisks and I will sort them into top spots. So yes, at one point we were looking at that not oil fund, but as much as I'm for solar in rural and in fringe areas, this company is like completely anti-oil, and it just doesn't work out. So every week I start with that overall list of triple asterisks, and then I weed it out and talk strategy as I weed out what we're not targeting and why. So if I go back, so closed-end funds, if we go back to that Motley Fool thing, 5 stocks under $49. One, what are the stocks? Two, are they paying a dividend? And since we're talking dividends, or since I'm going to talk dividends, so if you look at Apple, if you buy Apple, you're buying their stock at whatever price. They pay a 0.5% dividend. So let's say Apple goes up 10% in the next 5 years. Woohoo. So inflation, if you believe the Fed's numbers, that the Fed will reduce inflation 2%, great. Me, I think it stays at a pretty standard 4%, even when they say it's 2%. So using a 4% model, Apple pays a 0.5% dividend a year. But then you factor in inflation, so you're really losing 3.5% a year because your dividend is not countering inflation. So you're losing 3.5% a year over 5 years. So in 5 years, you've lost 17.5%. Well, the value of the stock went up 10%. Great. Well, you're still down 7.5% on the devaluation of your investment. That's not a great model. But if we look at closed-end funds and how we've structured our portfolio, I mean, we're invested and it's all self-managed. I like to track individual shares, but that's what we've invested. And that's our annual dividend, which is pretty darn close to 10%, even with that decrease in that HFRO stock. So this is what we've made in almost 3 years. That makes our overall return almost 15%. And that factors in what we've sold as well. So our annual yield is almost 10%. So if inflation actually hits 2%, which I don't think it ever will, regardless of what the Fed says, then we're making 8% a year. And if we hit 4%, which I think is much more likely, then we're still making 6% on our money. And I track what we sell overall. Like this is the just overhead, like general profit loss. And then I have a specific income calendar that is not specific to the day, but it'll look at what it's projected every month. And then you get to see what you're making overall in comparison to previous years. And this year I even broke it out a little bit further. And what we've sold. So a separate list of what we've sold emerged, but then plus the individual videos on specific individual targeted strategy. So I'll put it to you. Your strategy is your strategy. Just like my strategy is my strategy. You can pay the Motley Fool whatever their fee is to get 5 general stocks under $49, along with whatever it is they're selling. Or until I have an actual membership, which at some point, yes, my goal is to have a membership of this data and access, but I don't right now. So my encouragement would be to take what I'm doing for myself and then use that knowledge to your benefit. And if I ever do make a membership file, I'm not going to, I don't know what I would charge, but at the same time, I don't want to be a fool about it. My goal is to educate you and to educate you to the point where you can run your own portfolio and not have to pay somebody else to do it. Because at the end of the day, I want you to pay for access. I'm not interested, nor can I legally, but I'm not interested in running your portfolio for you. I'm going to run my portfolio. I want to help you. I want to help you learn how you can run your own portfolio and take on that responsibility. Because if you give it to somebody else, you're just paying them fees. And I'll be straightforward and honest. We have a separate portfolio at Morgan Stanley, and the guy who runs it, I like, but we have very different strategies. He's happy with a dividend, but he's looking on that overall growth of stock value over time. And that's great. But long term, inflation will eat those gains faster than he can make them. So long term, that portfolio and what's in it is not a great investment if we keep, or an investment vehicle if we keep it under the same management. So long term, we're looking at ways we can offload that portfolio and invest it other places. And right now, the best way we know to invest it long term is to split it between this methodology and investment property. And if you want to learn more about investment property and how to get from where you are to where you want to be, then come find me on Facebook, because I'm detailing out our strategy, the 12 steps to financial freedom, on my Facebook page, and I'm going step-by-step advice along the way. I'm also talking about our recent, not so much foray, but our recent acquisition of investment property. My wife and her business used me and my business to strategize and select an investment property. So I talk about that process and what's involved with it, and Honestly, all the strategy, all the boring strategy, as some may call it, but all the strategy and changes that went into picking the property we picked and making the changes we made in that loan and getting everything set up for a tenant. So whatever your strategy is, like if you're into single stocks, then I'm not I'm not telling you you're doing it wrong. I would I would ask you to consider a different strategy. And if you don't like this strategy, if you don't like this strategy, if it doesn't fit your needs, that's fine. Uh, but I would encourage you to continue learning and continue adapting and continue improving your own individual strategy. Because if you're just relying on the general increase of stock price, then even though you might make money on the general increase of stock price, inflation will eat you alive. And that 60-40 principle of stocks to bonds and that 4% rule, that stuff is dead. And if you want to know more about that, check out my other videos on closed-end funds. But from our standpoint, from my standpoint, the Motley Fool is correctly termed a fool. And maybe they're nice guys. Maybe they do a great job. I have no idea. But just based on how the business is branded, it's called fool for a reason. Because this closed-end funds and the discounts and the dividends and the access you get through a closed-end fund is so much better than what you could get for 5 stocks at $49 a piece or $48.99 a piece. If you want more info on these videos, then look at my other playlist, the closed-end fund playlist and or portfolio income playlist. And I get into closed-end fund targeted investment weekly. And if you search further back into the playlist, I get into the basis behind closed-end funds. So there we go. If you like this content, then consider subscribing to my channel and hit the like button. And by all means, continue to backtrack and view videos. If you want more info on financial freedom and our 12 steps to financial freedom, then go over to Facebook and find me there at Navigate Your Finances. The other thing you'll find if you search Adaptive Perspective is a new page I've started that is completely dedicated to scholarships and helping students source scholarships or find scholarships so that they can offload, right? Offload a financial burden, but also hopefully use that additional scholarship money to then get more into financial freedom. So my girls are getting home. I must go. So wherever you're headed, your dreams aren't going to happen on their own. You're going to have to make them happen. So know where you are, know where you want to go, and have fun along the way. Make your dreams happen. Work at them every day, right? Work, 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 but work at them every day. And if you need help, find me on Facebook. And I would love to help you make your dreams a reality. This is Daniel Young signing off. I will see y'all on another video. Bye-bye.